It's a pleasure to have with us today Shawn Kravetz, who is the founder and manager of Esplanade Capital. The Esplanade Capital Partners Fund was launched in January of 2000. It's a private investment fund whose objective is superior long-term capital appreciation through deep fundamental research and analysis. Shawn, welcome, and could you tell us more about your background, how you came to be a fundamental value investor, and a little bit about the genesis of your fund?
Delighted to do it. I grew up as a business guy. Around the dinner table, I was surrounded by business all the time, and quite frankly, I thought I would help to run businesses someday. And in fact, my first jobs out of college and business school were very much that, being a strategy consultant or executive. The more of that I did, the more I realized that the work we were doing, that research, that analysis, that insight generation, particularly in strategy consulting, could be used for a very different goal. So instead of advising an executive on how to run his or her business a little bit better, ultimately to drive shareholder value, that with a small tweak to it, we could use that for security selection. And undoubtedly overly emboldened by a bull market on January 1st of 2000, that's precisely what I did when we launched our first fund.
And maybe tell us a little bit about whether there were any classes that you took while at Harvard undergrad or later Harvard Business School that you feel like prepared you pretty well for what was to come.
Really, many of them did, not always in the ways you would expect. When I look back, a lot of courses that were not investment courses. In fact, I didn't take a single investment management course in college or in business school. Nonetheless, a lot of the analytical thinking that was taught in those years serves me very, very well today. In many cases, those were economics courses, but in other cases, they were government courses, other disciplines, social sciences, harder sciences, which just help you think, analyze, do research, think about things dispassionately, and ultimately try to find the right answer. With that said, the one capital markets course I took in business school, oddly enough, as I was preparing to launch my firm almost 13 years ago now, I went back and spoke with my capital markets professor and basically asked him if this sounded like a good idea, and he said it sounded like a terrible idea. Now, he obviously didn't have any insight into the 3 bear markets we've had since then, but nonetheless, despite those cautious words, what I learned has been incredibly valuable.
And could we learn more about your investment approach itself? What do you look for when it comes to businesses?
Well, I'm glad you used the word businesses because that is how we think about things. We invest really in stocks primarily with an occasional bond, but we think about the businesses, and the bottom line is that we typically are seeking to buy growth companies at value prices. And in our kind of Hall of Fame, we see companies where in the year or 2 or 3 that we own them, typically, we see fairly dramatic earnings and or cash flow growth and multiple expansion, getting sort of a lot of bang for the buck. Sometimes, in fact, most of the time, we need to look a little bit out of the way, under the radar screen, etc., to find what have often been smaller, messier, more opaque, turnaround, off the radar situations where we hope we can see things that other people aren't seeing. I would say that today is reasonably typical of that, and most years when we've been in business have been typical of that. There are, however, occasions when we have the luxury to buy big, juicy, well-known global growth franchises. I would say a year and a half ago, for example, was a pretty good example of that, when investors didn't have to do anything terribly fancy. We actually had a maybe once a decade opportunity to buy great companies, whether it is a Lowe's, a Microsoft, an Apple, that list is long, at wildly attractive prices for the patient investor when they simply were out of favor versus some of their smaller and perhaps more exciting brethren. But the core of what we do is growth companies at value prices, and when we don't do that, we lean more towards value, and in some cases into quite traditional deep value.
And so when you say growth companies at value prices, it sounds a little bit like the Joel Greenblatt magic formula screen. Is that something you run or look at for idea generation at all?
We do look at it, and it's always interesting. We inevitably share a holding or two at any given time. And so it's not exactly that, but it's not dissimilar to that. But it's funny, we were just looking at it the other day, and there was overlap in the portfolio, and there was overlap in things we had looked at recently. I won't go so far as to say that great minds think alike, but we always enjoy seeing investors we respect on our team.
One of the things about the Greenblatt screen, I think, clearly the cheapness aspect of it is very clear, but then it seems like a lot of companies that end up on that list, it seems like they might have had their best days behind them. And so how do you, with that kind of a price, how do you actually find companies that still have growth ahead of them?
Well, that's true. Often they have had their best days behind them, but with that said, if you were a captain of the football team in high school, you may never play for the NFL. You may never, have that esteemed position again in life. But if you're trading at, 4 times free cash flow, we still might buy you. So it's not about where a company's been, it's about where it's going. I do think that a number of companies that turn up on that list are cheap for a reason, and that business is actually going in the wrong direction and will likely continue to, and those may be value traps. With that said, that's a portfolio. We manage a portfolio, and what we do every day, that we do some screening. Really, the lion's share of what we do is fundamental research on the ground around the world to help ensure that we are not buying value traps. We are not buying companies who are shadows of their former selves and have no real hope for the future. We're trying to find companies that in fact can grow again, can turn around, can enjoy the benefits of excellent marginal economics when people either have left them for dead or, in most cases just don't fully appreciate the good things of what might be going on at the company at any given moment. As a result, it's a little bit trite, but we often find those micro caps and small caps and mid caps, and we sell them when they're small caps, mid caps, and large caps.
And how do ideas actually enter your funnel where they're then considered?
Well, we're very focused on a handful of sectors, and because of that, we know most of the companies. We have built relationships over the years with researchers, sell side, other investors, industry folks. So we do our very best to stay on top of the core ideas in our sectors, so we're not recreating the wheel. Once in a while, something happens to one of those companies when, in fact, an old friend becomes a new investment. It may be a company that is a fallen angel that we knew or invested in a decade ago, and They miss a quarter, miss a year, have a management change, or see their stock price impacted in such a way that it once again becomes a compelling risk reward for us. So just staying on top of our favorite sectors, um, talking with other thoughtful, like-minded investors as a starting point to get us to say, hey, we should go do our own work on this idea because a firm we respect has made an investment, and that's a wonderful starting point for us. The biggest single thing we do is just read. We read and process a fantastic amount of sell-side research, industry reports, and we're out there in malls, at conferences, etc., looking for, new ideas, new companies that have been left for dead, and doing our best to whittle it down to see if it might ever fit in the portfolio.
How do you define your circle of competence, and what are perhaps some of the sectors or industries where you've found a lot of interesting businesses to look at?
Well, those two are tightly linked. We spend the vast majority of our time thinking about a handful of industries. They include retail, consumer products, casino gaming, business services, education, and solar power. There are times when we will make investments outside of those core sectors. Typically when we do, it's for one of two reasons. Reason number one is we see a business that we see differently. We've made a few financial services investments that fit this category. For example, a few years back, we invested in Commerce Bank. We thought it was one of the best growth retailers we had ever seen. As you know, growth retailers usually trade at 20, 30, 40, 50 times earnings, and this company traded at 10 or 12. Viewed through the lens of a growth retailer that was in 3 markets in the United States with very strong comps, very good unit economics, et cetera, this stock was a very, very compelling long-term growth story. That particular company had lots of other issues that I won't get into right now, but nonetheless, it treated us very well, and it's that type of differential thinking that we love when we can see an education company in the guise of a finance company, a bank in a retailer in the guise of a bank. On the other end of the spectrum, there are times when just the markets are at such extremes, whether it's after 9/11 or in early 2003 or to a certain extent, roughly 18 months ago, when we see the opportunity to own broad categories of stocks that aren't classically in our sweet spot, but where the risk reward is just irresistible. So by sticking primarily in those sectors, using market extremes to our advantage, and really then sticking to our knitting of finding value and being incredibly disciplined about it, we really stay within our sphere of competence and hopefully are rewarded for that.
What was it that got you interested in solar power and those companies?
That's a good question. One of these things does not look quite like the other. Solar seems very exciting and expensive and futuristic. And at times, it has been some of those. We started to look at solar very serendipitously over 7 years ago now. And solar had some really interesting characteristics. It was growing very, very rapidly and had some of that excitement that technology had in, let's say, the early 1990s. With that said, what made it truly interesting for us was, one, it was that actual parabolic growth opportunity that people talked about in the tech bubble and in the internet era, where in this case it was just so different. We weren't talking about everyone in China having a cell phone or everyone having a Sun server on their desk. It was electricity. and at less than 0.1% of global electricity generation, we could see clearly the massive multi-year growth opportunity. Two, we loved the fact that it was viewed as sort of a hippie, space age fantasy, and a technology-driven one at that in the U.S. But in Germany and Japan, it was just a way of life. And we love that sort of anti-home bias that we could see changing in the coming years. Last but not least, some of these companies did a crazy thing. Unlike a lot of tech companies of their era, and unlike, say, biotech, where you're playing an odds game of sort of hitting it big and getting it right, some of these companies actually made money. Q-Cells, a company we owned many years ago, made money as a private company, made money as a public company. And when we put all of those things together, we said there's a massive opportunity here. And in fact, since we started investing in solar about 7 years ago, global solar demand has grown approximately 25-fold. There have been great successes and great failures in the stock market, and clearly the past few years have been incredibly challenging. We were and remain so excited about the opportunities in that sector, we actually launched our second fund almost 3 years ago to focus on opportunities in solar and companies that are impacted by solar. So we love the sector. It is not the classical value investor sector, but it's done well for us, so we're delighted to be there.
And can you tell us a bit more about how you make the economic case for solar power? Because today, there's the perception that the solar companies thrived while there were a lot of subsidies, and now that those are being reduced, they're in a lot of trouble. And, I've tried to really look at what are the economics, and it just seems like there are these two arguments being made on one side and the other, and for someone who knows little about technology or solar cells, it seems pretty hard to sift through them and gain some conviction on whether solar can be viable without subsidies.
Well, all of your points are fair. I guess the good news is if you look at the data, there's just not that much of a debate. Solar is viable right now in a handful of parts of the world without subsidies, period, full stop. So with that said, subsidies have played by far the most important role in the massive growth of the sector in the past decade. And yes, those subsidies are decreasing, and many of them are at risk. But one has to think about solar on a market-by-market level. And, if I told you that Germany was the largest solar market in the world, that intuitively doesn't make sense. The sun is lousy. Electricity prices are not the highest in the world. They're relatively high, but they're not crazy. But it's government policy that has made that happen. There are parts of California, there are parts of southern Italy, places in Hawaii, the list goes on, where even without subsidies, you can generate a very attractive return on a solar investment. And that's whether you're thinking about a small power plant or putting solar panels on the roof of your house. And in a world where, at least in this country, for example, which admittedly is less than 10% of global solar demand, but in the U.S., there are a number of states where you can generate a high single-digit, effectively after-tax, very low-risk return on putting solar panels on the roof of your home. Now, that's not a 3-year payback, but in a world where, you can make 2% on a 10-year treasury note, all of a sudden 8% after tax versus 2% pre-tax, that sounds pretty darn good. So subsidies make a profound difference today, But thanks to the experience curve in a rapidly growing industry, as those subsidies continue to decline around the world, although not everywhere. For example, Japan has just instituted an extremely attractive feed-in tariff. As those subsidies fall, we believe that the cost of putting a solar panel on your roof will fall at least as much, making the economics look better and better, even when the day those subsidies truly go away in lots of important markets. So it is a challenging market right now. Many of the players are not making money. We think that continues for the coming handful of quarters, but it is in these shakeouts that we think big turns will create big opportunities.
And where in the solar value chain do you think the best returns on capital are to be had? There are obviously a lot of public companies that make solar panels that look extremely cheap, trading way below tangible book value now, some with very decent balance sheets. But is that a good place, or would you go somewhere else in the value chain?
So as we look at the value chain, I think there are three broad buckets to think about. Bucket one is upstream. Those are the companies that manufacture specifically polysilicon. Polysilicon is the gold of the solar universe, and there was a time when that afforded these specialty chemical manufacturers, 50-60% EBITDA margins, fantastic returns on capital of these very large plants, etc. Unfortunately for them, those days are over, and we remain short some manufacturers of polysilicon where prices, which stabilized in the, let's call it $50 to $80 a kilo range for over a year, well, those prices are now in the low to mid $20 per kilo. And when something costs roughly $20 to manufacture, as you can do the math yourself, the impact on the economics is quite profound. So we remain short polysilicon manufacturers where there is still way too much supply at these prices versus demand, and where the valuations remain, we think, rather generous. When I go to the other side of the value chain, downstream, we think that's the most attractive place to be today, because downstream is the one part of the chain that actually benefits from some of the carnage going on in the solar markets. When the cost of polysilicon and wafers and ultimately solar panels falls as precipitously as it has, I want to be a buyer of those inputs, and downstream developers of solar projects are the ones who actually benefit. Now, again, they're not immune to lots of risks out there, project financing in Germany and Italy, for example, things like that. So there are plenty of risks there as well. But that is where we see the biggest opportunities today. Unfortunately, there are precious few companies that are not even pure plays, but where that's the true engine of their business. But we happen to own one of them, and think it's a very compelling investment. In the midstream, as you've described, some of the solar panel manufacturers, et cetera, we think we're getting close to where a number of those companies become very compelling investments for the patient long-term investor. With that said, one has to pick and choose very carefully, and the calculus is tricky. Some of the classic, when we look at investing in companies, we always like to look at valuation metrics the way everyone else does, because if an industry is looked at on a PE basis, then PEs move stocks. If it's enterprise value to EBITDA, that's what moves stocks. So we like to understand that, but we also like to think about ways that really create value, but that are often overlooked by other investors. The book value argument in solar is a very difficult one. When stocks are getting crushed and companies have no earnings off which to compute PEs, for example, people often come back to book value. The problem is so many investment mistakes have been made, so many acquisitions capital investments have been made, that the goodwill and other write-offs to come, inventory write-offs, receivables write-offs, there are a lot of those yet to come, which will start to decimate book value for a lot of these folks. It will also decimate tangible book value. So we have taken our 7 years of experience and created really replacement cost analyses for all these companies as well. Now, again, these are our proprietary models, and they'll all be wrong to a certain extent. And so there's nothing to say that when a stock hits our view of true replacement cost, it's suddenly going to stop and turn on a dime and turn around. But boy, it sure helps you sleep at night when you know that there is true intrinsic replacement value, even while cash flow and after-tax earnings may take a while to start percolating again. All of that said, we think there are opportunities in the midstream, and we are very close to a handful of situations where the companies are trading comfortably below replacement value, where cash flow, EBITDA, and net income is coming, if it's not already there, and when these companies can actually start to grow again, both top and bottom line. So the midstream is getting close, but still tricky. For every winner, we believe there will be a loser, maybe two losers in the next year or two. But by being short some of the upstream and long some of the downstream, we hope we're well positioned come what may.
And do you think it's actually possible to really understand the companies based out of places like China that have come under a cloud for, accounting issues and things like that? Is that even a place you would look at, or would you be more comfortable with companies that are in geographies like Germany or some other countries you mentioned?
All else equal, it would be a lot more fun to invest in something in Boston, Massachusetts. It's a much quicker commute. I speak the language, no currency. I say that for a fact, obviously. Most of our investments in solar specifically have been outside of this country. Part of that is because, the majority of the solar panels manufactured today are made in China. So if you're not thinking hard about China, your universe is dramatically decreased. There are always risks. We do our very best to understand, measure, contain them. With that said, our due diligence process helps to do that. It does not ensure anything, but for a lot of these midstream companies in China, and examples include Trina Solar, Canadian Solar, Yingli, Suntech, JA Solar, and the list goes on. We've been to their headquarters in China maybe 20 times. We've met with dozens of executives all over the world. We've been to lots of different factories and warehouses over the world. In some ways, more importantly, we've spoken with dozens, if not hundreds, of their customers, both distributors and end users who buy these products, who put confidence in the company that this asset designed to last 20, 25 years is going to work. We've spoken with the banks that guarantee some of the financing for these projects. Again, you can't always get it right and remove all risk, but we've done our very best to understand and manage the risk. And we think there are terrific opportunities, both long and short, I might add, with some of these solar companies in China. And part of the way we manage those risks is just having a higher, expected return and sort of a risk hurdle. Ultimately, we think that'll pay off for us.
I would be remiss if I didn't ask whether you're willing to talk about one or two opportunities that you like at this time.
I'm delighted to. We can talk about one in solar, or one that is at least partially in solar. It happens not to be a Chinese company. It happens to be an American company, and I'm delighted to sort of give a quick summary of that.
That would be great, please.
So that company is MEMC Electronics, ticker WFR. MEMC Electronics is a storied American company founded 50 years ago. It was a pioneer in silicon wafers. At the time, that was really for the semiconductor industry. And that's how it built its business for over 40 years, with the growth of that industry behind it and the cyclicality as well. Today, it's roughly under $600 million market cap, is roughly 95% off of its all-time highs, and is kind of viewed as a Cerberus, kind of a three-headed dog, and particularly today with the stock at multi-year lows, it is arguably truly a dog. For us, it is a sum-of-the-parts story, a sum of the parts that dramatically exceeds its current valuation. So what are the parts? The first part is the original business, the semiconductor wafer business. And until 5 or 6 years ago, that was really the entire business. That business has been in a cyclical trough, and with their report today, that business is finally turning, generating a little bit of EBITDA, and that is a business that can actually have a pretty decent second half of 2012 and 2013. Our view of that business is such that it in and of itself may be worth at least as much, if not substantially more, than the entire equity cap of the company right now. Part two is the solar polysilicon wafer business. This was a very exciting business and was the engine that drove the massive revenue, profit, and share price gains from roughly 2005 to 2008. That's what took the stock to all-time highs. Unfortunately for the company, probably fortunately for us, but unfortunately for the company, the ensuing collapse of that business really obscures the value of the other two businesses. That business is under immense pressure. That's the upstream business that I described earlier as something that Esplanade overall was short. The good news is that no one in their right minds really thinks there's much of value there. They might be able to get something for it from an acquirer, and so now it's sort of it's an issue of minimizing losses, eking out a small gain, but let's call it a neutral. And thankfully, while the company is making many mistakes in our opinion, they have mothballed some high-cost capacity. So let's call that business a push. Last but not least is a business they acquired in 2009 by the name of SunEdison. SunEdison is really the underappreciated jewel of that whole company, and though they are unfortunately not optimizing it as far as we're concerned, it is a leading solar project developer. Again, the part of the value chain we think is most attractive right now. They have a tremendous pipeline, a chunk of which has very, very attractive PPAs already. And that business should create immense value for the company in the years to come. Unfortunately, the company's balance sheet is getting in the way of driving that business quite as aggressively as perhaps it could be driven. Moreover, because it is such a different business where you are investing a lot of capital creating an asset that will potentially be sold or managed through a sale, leaseback, etc., but with 20 or 25 years of cash flows, it's just a very different accounting and cash flow animal than anything the company has ever been involved with before. So even if that segment were kind of humming, it would still be it would not likely generate maximum shareholder value in the current company structure. So net, the enterprise value of the company, we think, could be represented by either the semiconductor business or the SunEdison business. And so we're buying a company at literally multi-year lows where we think there is a turn in potentially all three businesses, but at least two of the three. And for the patient investor, we think is a terrific long-term opportunity.
Now, SunEdison, are they in the same business as Solar City? Is that pretty much that market?
It's directionally in the same business, but Solar City is much more of a residential and small commercial business.
Mm-hmm.
So it's sort of the same basic variety, but whereas Solar City is more like a single-serve Coca-Cola, SunEdison is more like a 55-gallon drum that you'd buy at Costco. Their clients are typically much, much larger. They've done some of the largest solar installations in the world. But yes, directionally speaking, they are in the same general business. And again, it's, when you think about Solar City, for example, likely to be going public soon, again, it shows you where in the value chain the most value is starting to accrue.
And do you see a lot of balance sheet risk with MEMC? I know a lot of their long-term obligations are non-recourse, but do you think they'll have to give up some of those projects that are related to those obligations?
We don't think they will have to. They may choose to generate liquidity, but I guess I would say that Wall Street, particularly literally today, obviously does see balance sheet risk. It was not long ago that cash at the corporate level roughly equaled debt at the corporate level. Cash this quarter has fallen meaningfully and debt has picked up. The majority of the debt at the company is non-recourse to SunEdison, and it's backed by extremely valuable, high-quality projects. These are the types of projects that, for example, Berkshire Hathaway's Mid-American just bought. So these are not kind of arcane, questionable assets. These are things that Mid-American and the Duke Energies of the world are just buying. So we are not overly concerned with the balance sheet of the company. There's, of course, always risk there, and we hope and expect that the company is managing that carefully. There is one asset in particular in Bulgaria that literally could be north of a $200 million asset that we hope they will be selling soon. That will create a terrific inflow of liquidity. But I think that's a very healthy chunk of why the stock is where it is today. And we actually like it when a company has, at least within its power, the ability to make a few decisions which transform the near-term liquidity outlook. Again, we want them to get the right prices at the right time. So it is a risk, but one we hope and expect the company will manage prudently. And today, in many respects, the stock is trading as if it is a true credit risk. And again, we think we'll be rewarded for taking that risk.
Do you still have confidence in the CEO there and management strategy? Would you want them to actually try to spin off the downstream the downstream business there?
We would love to see them break up the entire company, because that is the value maximization approach. There's no question in our minds. There are, I'm sure, ready buyers for the semiconductor business. You might be able to get something for the solar wafer business, and there are lots of folks who would buy an asset like SunEdison. At the very least, you could sell pieces of the backlog, but SunEdison and its backlog is just a fantastic asset. There are a lot of companies that would be buyers of that. That is the right answer. Again, we don't think you need that to do very well as a stockholder from here, but in terms of value maximization, that is absolutely the right answer, not least of which you would eliminate a massive dose of corporate overhead, which just isn't needed anymore.
And do you ever talk to other investors in the companies you're invested in? I think there's Alte Capital is, I think, a shareholder of MEMC. Would you ever talk to others about the strategy you'd want management to take?
Well, without commenting on MEMC specifically, we frequently speak with other investors about things we are looking at or things we're invested in because we're trying to learn all the time, and proprietary research that we're doing can be useful to other folks, and other hard work that other people are doing at times can be useful to us. So the not invented here syndrome just does not apply to what we do. We often try to talk with folks just to learn a little bit more. On the MEMC front, again, I can't speak for anyone else, but my sense is that, well, I know how we feel, and we feel a tremendous amount of frustration and disappointment, both in what the stock has done and in some of the execution of the company. Some of this is the solar market, the semiconductor market, things that no management team can do anything about. So I know our frustration, and I suspect we're not alone.
You mentioned there was perhaps another idea you could let us in on. Could you talk about that as well?
Sure, happy to. This is a very, very different type of idea. The company is Lakes Entertainment. Lakes Entertainment is a very, very small company that is in the casino gaming business. It has a sort of a storied history. It once owned World Poker Tour, and again, I guess a little bit like MEMC, was once a much, much larger company, but has gone through quite a transformation in the past few years, and today, in some ways, seems quite complex, but in other ways is quite simple. It has a history of different relationships whereby they worked with different Indian tribes to help establish and manage Indian casinos around the country, and there's a lot of historical residue, but for us, it's actually an incredibly simple story where a company that today has a market cap of roughly $60 million has almost $40 million in cash. So we're paying effectively $20 million for this business, and we only started buying the stock roughly maybe 10%, 12% lower than where it was today, when we were actually paying very little for the enterprise value of the business. And what we're buying is really, I think, in 5 pieces. The core, the most immediate, and we think most exciting part is they own effectively 8% of a brand new casino that is opening in Cleveland, Ohio on May 14th, parentheses, Monday. This is going to be a wildly successful local monopoly. where they, in partnership with Rock Ohio Ventures, which is Dan Gilbert from Quicken and the Cleveland Cavaliers, and Caesars, will own this casino. Uh, it's not effortless to estimate the EBITDA and cash flow generation of a property like that, but it's pretty reasonable to assume that this could be $100 and maybe $150 million EBITDA business at steady state. Having looked at lots and lots of assets kind of like this, and at that basis, that asset in and of itself could be worth very close to the current market cap of the company. Again, not the enterprise value. It's actually worth a multiple of the enterprise value, but it could end up being worth almost as much as the current market cap. So that's a great place to start when one asset is sort of worth the whole shebang. They also own an 8% interest in the Cincinnati Horseshoe, which will, in all likelihood, open in the next year and a half or so. Again, same partners, same structure, etc. May not be quite as valuable an asset for them and requires more investment before it gets there. But again, a very attractive local monopoly that Lakes will benefit handsomely from in the next couple of years. They are going to be building and opening a casino in Maryland, where they have all but their very, very final approval for. Again, we don't believe this will be a massive value creation property, but again, as we model the economics, this could end up being worth roughly as much as the current stock price. So again, we're sort of at least two assets which in and of themselves may be worth as much as the current stock price. They have some notes receivable from previous Indian casino deals that are largely written off. To us, again, being conservative and to sleep well at night, we think of them as being basically worthless. If they were paid off in full, you are getting a substantial chunk of the current equity price in cash. Again, we do not believe that will happen. Anything will be icing on the cake. And lastly, we have future development projects. The founder, Lyle Berman, isn't in this business to make a few bucks here and there. He has made some very exciting things happen, like his involvement in Rock, Ohio. And so we're getting kind of a free option on other interesting deals to be done in the coming years. The negative is we're paying corporate overhead while all of these things are happening, and because this is a small company, that corporate expense is quite meaningful. And if you give that sort of an EBITDA multiple, that can potentially take away effectively a market cap of the company. So net, we have a small collection of assets where we believe, an immediate catalyst in coming days, weeks, months, and a collection of assets that in the low case is worth somewhat more than our current equity cap, and in a high case could be 2 or 3 times, potentially more, but conservatively 2 to 3 times the current market cap of the company. And we think that as they finally have operating assets and potentially even monetize things, if, for example, Rock, Ohio were to go public, we think it's a very, very interesting part of the portfolio.
And how do you assess management there? Obviously, Lyle Berman owns 18% or so. Do you think management is adding value or taking away from value?
We think they're adding value today. They have in the past, gotten into a little bit of trouble with assets, but they've done some impressive things, and when their backs have been against the wall, they've found creative solutions. So, Lyle is on the team, is by far the largest shareholder, um, and right now I like being on Lyle's team. I also like being on the team with Gary Loveman from Harrah's and Dan Gilbert. It's funny, during the Caesars Roadshow, a lot of people asked about Ohio. And Caesars is, managing these projects and has a 20% equity interest in them. But, Caesars is a $20 billion enterprise value company, and people are asking about Ohio. We, through Lakes Gaming, own a company that has 40% of the economic interest that Caesars has in these properties. And at the time Caesars was going public, had an enterprise value approaching zero. So there's a disconnect in there somewhere. We think this is a very nice collection of assets, and again, for the patient investor, maybe they won't have to be too patient in this case, but for the patient investor, we think there's opportunity there.
And what would you like to see the company do with the cash?
Well, in the near term, Rock, Ohio is not likely just to, dividend out this cash or anything like that. It's possible because of the way it's structured, but we believe they will use that cash to make further capital investments, et cetera, eventually to help fund Cincinnati. So we are not expecting a windfall of cash, but what we're expecting is a windfall of value. And so again, Caesars and Dan Gilbert are clearly going to be very focused on creating value, and we like being a junior partner to them. And again, if by some freak chance Caesars/Harrah's said we want to own these assets, that would be an insane catalyst. If Rock, Ohio were to seek going public, that would be a fantastic catalyst. But the most likely case is, wow, here's a wildly successful casino where most of the capex has been made, and we own, 8% of that, which could be $10 million plus a year. That's a lot of money for a company with an enterprise value of 20.
Can we move on a little bit to the portfolio, how you structure it, and how much concentration you like to have in the portfolio?
We do manage a fairly concentrated portfolio because we want to know our companies as intimately as best we can, and we want good decisions to have an outsized impact on the portfolio. We obviously manage the flip side of that, is we don't want mistakes or things beyond our control to have a destructive impact on the portfolio. As a result, we think of a full long position as being 7% of capital, and the full short position being approximately 3% of capital. And with the sectors we are most involved with those position sizes, with the way we think about industry exposure, that has allowed us to build a portfolio where we can sleep at night and hopefully deliver long-term superior capital appreciation.
Would you say that your approach has been tweaked or changed at all as a result of the experience of the last few years?
I would say it has a bit on a couple of fronts. One is we use a bit more simple derivatives than we had in prior years. Occasionally that's for equity replacement. Occasionally that is for risk management or speculation. Again, option markets are awfully smart and they're rarely free lunches, but there are times when we've seen opportunities to pay up for that option premium in order to protect a substantial amount of capital in the portfolio. So that, I say, is tweak, not an abrupt change, but tweak number one. And tweak number two is that these markets have required us to trade around positions a bit more than we had in previous years. You know, literally, it seems daily we see stocks move 10 or 20%, sometimes for no apparent reason. Now, that in and of itself doesn't make us want to trade anything, but if you got 3 days in a row like that, which again happens, we want to be able to make some money and be able to have even more firepower and conviction to buy more when a stock we love is down sharply over a month or a quarter. So we are extremely respectful of taxes, but with that said, and partly through the use of derivatives, we do seek to trade around positions a bit more today than we did, say, 10 years ago.
And when it comes to mistakes, what would you say is one or two mistakes that stand out most to you that you see smart investors making?
You know, I think the biggest mistake is a very human one, which is the lack of discipline. You know, people will make investment decisions that are poor. Things will happen beyond their control. But the big mistakes are made at extremes, and those are, you know, giving in to that psychological temptation. It is selling stocks in March of 2003 and March of 2009. It is buying stocks in late 1999. It's going to cash at the worst moment. It's buying gold at the peak. It's all these very understandable lapses of discipline when the core plan, you know, the investment allocation, the stock security selection, when that was perfectly sound, where maybe it's no better or worse than average, but average is pretty good, you know, without sounding like Jeremy Siegel or Jack Bogle here. You know, over the long run, average is going to do people just fine. The problem is, you know, in the 12 and a half years in which we've managed our flagship fund, you know, the S&P 500 is barely up. And unfortunately, many investors have seen returns far worse than that because they put a little bit more money in early 2000 and then pulled some out in late 2002, and you know, the saga goes on and on. So the modest return has become a modest loss, and so forth and so on. So the biggest single problem is that lack of discipline, and again, we hope our discipline is sound, and when you add good security selection, that's hopefully a powerful combination.
Shawn, lastly, are there any books that you've enjoyed particularly that you would recommend to others?
Well, I'm delighted to share a couple of thoughts. You know, we have an Esplanade Capital recommended reading list that we share inside our small firm and share with friends of the firm, investors, etc. And not surprisingly, it includes you know, a good chunk of the canon of the history of investing. You know, whether it's The Intelligent Investor or, you know, Against the Gods, Breland Myers, Michael Porter's, Taleb's, everything in between. With that said, I think of the archetype category, the one I would, if not most highly recommend, differentially recommend is In Search of Excellence. You know, In Search of Excellence, and this gets us back to where you started this, John, In Search of Excellence by Tom Peters and Robert Waterman, it's about greatness in companies. And, you know, it's not going to be for every investment you make, but they're timeless insight into what makes truly great businesses. The way they talk about kind of the Walmarts of the world in the early days, that to us is invaluable. In terms of more recent books, I would say Paper Promises. Paper Promises by Philip Kogan is a fantastic piece of work that really distills a lot of the macro events of the past couple of years quite beautifully.
Well, Shawn, thank you very much for your time and insights today.
My pleasure. Thank you, John. Good luck.